When you look at the number of infections rising, what are the chances that actually in certain parts of the world, I'm thinking of Europe, maybe the UK, we see a double dip recession?
So the first thing I think we ought to talk about with regard to that is that, yes, there's been positive growth off of a very, very depressed second quarter. But from level terms, we actually aren't out of a recession right now. When we think about the labor market performance, when we think about aggregate demand, we're not actually out of a recession. So double dip maybe is a misnomer.
What is the biggest risk that we're underestimating at the moment, Catherine? It seems that, China's doing okay. Chinese stocks were rising on the back of a possible Joe Biden presidential win. But if the rest of the world isn't buying their things, then actually China will be in trouble too.
Well, China is a country that has been able to use export growth in order to support its GDP growth. That's kind of been a standard playbook for them. But it is also the case that they have been ramping up their own expenditures internally, both consumption, principally investment, but consumption has been coming back a bit as well. It's also an economy that doesn't depend as much on exports as it used to. So China can use internal demand, particularly supported by fiscal policy, in order to probably stay the course. In other words, continue to grow. But it's not a global economy that is in good shape. In the last 2 months, in our September and our October outlooks, we've downgraded global growth 30 basis points each month. So for a total of 60 basis points downgrade over the last 2 months for global growth in 2021. So if you're a private sector and you're looking at that and you're saying, should I invest? Should I do capacity development through CapEx? The answer is no, because you're not looking at a growing marketplace. So when business investment is moribund, in contraction in most cases, it's a real challenge to get domestic demand-led growth.
Dr. Mann, I've got to ask you a pro question. I was honored to have Alan Ruskin of Deutsche Bank on with us yesterday, and now you, off the fears of a weak dollar. I did the fancy math, and off of Plaza Louvre in the 1980s, we saw a 28% plunge in the dollar off of a 2 standard deviation excess. That seems unimaginable now. Do you have a weak dollar fear, or can it be contained and not like the early 1980s?
I think that back in the 1980s, first you had policy intervention, and that was part of it. But the second thing is that I think that there was more opportunity for other economies to have their currencies appreciate. There was more room for them to be able to absorb an appreciation of their currencies as the dollar depreciated. This time around, there's not a lot of room. And there's also not, when we look at the prospects around the world for which economies might be doing better and therefore be attractive to capital inflows and therefore have their currencies appreciate, you can't really find a whole lot. Some scattered, improvements in some of the emerging markets that have done well, sort of in the Asian bloc. But none of those markets are big enough to really absorb the type of capital flows that we would be talking about. So, we always get to be talking about currencies as relative prices. You can't talk about a dollar depreciation or dollar weakness in isolation. It's always relative to something else. And I think especially in light of the COVID second wave in Europe, it really puts a damper on the euro as a currency to source.